Christians who invest are not merely seeking returns, we are making moral judgments about the kind of world we want to build. When we buy stocks or bonds, we are not neutral participants. We are providing capital that enables certain activities, behaviors, and incentives. Scripture reminds us that the earth is the Lord's and the fullness thereof, and that we are stewards, not owners. The question then is not whether Christians may invest, but how we do so in a way that avoids ill-gotten gain and actively promotes human flourishing. So Spencer, we've touched on avoiding ill-gotten gain quite a few times, but the reality as we look at what does it mean to be an investor? What does it mean to clothe companies in capital, whether that's through an ownership stake or a lending stake? We need to really wrestle with what does it mean that I participate with companies in their profit margins. So as we take a look today, we're going to very briefly touch on ill-gotten gain. Then we're going to really dive into what are public stocks, what are public bonds, what even is a stock, what is a bond, and then how do we as Christians really wrestle with the opportunities that we have set in front of us. So as you think about ill-gotten gain, if you can define it briefly, how do we think about that from a Christian perspective?
Well, there's a number of different passages that we could go to, Proverbs 1 being a central one. We look at the Old Testament. We also look at some of the New Testament passages, but basically anything that harms an image bearer. And we're not talking about ancillary harm here. I mean, we could all say, okay, you walk into Walmart and there's a lot of things that you could buy that would be good for you, some that would be bad for you. We're not talking about that. We're talking about a business line that what their primary business line is harming image bearers as defined by Scripture. So we would come back as well to this idea, in the Old Testament that the Lord did not want the prostitute to bring in wages based on that line of work and present it to the temple. So the Lord doesn't want, I would even argue the Lord doesn't want our gambling winnings. Lord doesn't want a lottery winning, I don't think there, to be brought in and used for, his purposes. There's way too many ways then that we can justify ill-gotten gain or gains that are really harming another person being brought in and then being used for the Lord's purposes, being, baptized or whitewashed, there. And that's not ever what the Lord tells us in Scripture, because he says, I'm the creator, I'm the owner, I want you just to be faithful first. So I think, we come back to ill-gotten gain, and that's how we would look at it more holistically.
Yeah, absolutely. And as I think about ill-gotten gain as a kind of framework, we look at what are those places that ensnare image bearers of God into addiction. That's kind of one of those frameworks that I start thinking about. Are these companies in their profit derivatives, how they're making their money, are they ensnaring image bearers into deadly addiction? Whether that is alcohol, tobacco, gambling, pornography, some of these other things that really steal your life away. I think Instagram steals life away, but it's not necessarily, it can be a physical addiction, but there's other aspects of Instagram that connect people to one another. You could say the same thing about smoking or tobacco, or alcohol, but Instagram does not derive 70% of its profits like alcohol does from those that are addicted. So I think we just have to look at this and say, okay, what are those things that are damaging? What are those things that God calls out to say, avoid this or stay away from that? And we look at that on ill-gotten gain. So,
well, and I think it also shows, just even your thoughts there would show that this would be something that we would encourage all clients to wrestle through. Because we have some clients that would say, okay, I'm going to avoid Meta because I know the level of addiction that it creates in teenage people, and I'm not even saying, Meta with Facebook, but with Instagram, with other assets, that Meta owns, you could make that case. Other people might say, I've had a very different experience with Meta. I've been connected through Meta. And so they may say, well, that's not something that I think is ill-gotten gain, or is a company that is going, a path that is antithetical to my core values. So I think this is something where there is some, there's room for discussion. I think, there are some companies that I think, we go back to like RCI, to Rick's Cabaret, and say, okay, it's really hard to make a case that this is aligning anything with the gospel here. But you go out and you could make a case for or against all kinds of different companies. Another one that comes to mind would be Monsanto. There's some folks that think that Roundup is the devil, and there's other folks that think that Roundup is great for helping a variety of different things. So I think we look at this and say, okay, ill-gotten gain is a concept that I think is you can't really move away from, but how you define what is within that concept, there are some gray areas around the edges there that we just have to acknowledge.
Right. And I think the reality is, as we look at Scripture, God does not want to see image bearers' lives being taken. And so when we think about products that lead to death, those are some of the big ones that we say, hey, let's absolutely try to avoid a product that benefits from the destruction of a life. So let's go ahead, and now that we've kind of got this ill-gotten gain theory on the table, we recognize there's gray areas, we recognize there's a lot of challenges as we look at public equity companies. There is no perfect company. We are all image bearers. We all are people that are broken and sinful, that when we run a company, I'm going to do something different than you that may offend you. That is part of being human. But we don't want to say, well, because all companies are run by sinful image bearers of God, no companies are worthy of investment.
Right.
So let's go ahead and take, from just a foundational perspective, what are public equities and how do we start thinking about being investors in public equities?
Well, technically, you have public equities. They're traded on the secondary market. So what happens with a typical company, entrepreneur has an idea, he or she brings in, friends and family, maybe to help fund the first prototype that might be built or the first service that might be rendered there, but quickly realizes, okay, there's a scaling here that I can't do without bringing in some other folks. So they may bring in venture capital. They may bring in other kinds of investment in there so that they can grow to a certain size. Well, they grow to a certain size, and then there's a recognition within the marketplace that, oh, they're very good at what they do. This is a stable company with a lot more upside. But again, they need to raise some more capital. And maybe those early investors say, well, I put in $15,000 and now the company is worth, $50 million. And my $15,000 might be worth, $1 million. They might like to cash out there. So what happens is oftentimes an initial public offering or an IPO. So you essentially work with a lot of different lawyers and CPAs and such, but you go to market with this IPO, and what that enables is some of the early investors to get out, to sell some of their shares into the public market and allow people to buy those shares there. And so that's the initial public offering. But then thereafter, usually that company is trading on a stock exchange. So that's a secondary market. So essentially that's the life cycle of a company. Now, oftentimes you have companies that they never make it there. I mean, the vast majority of companies, they're never going to be publicly traded. There's only a few thousand publicly traded companies in the United States, the large companies, oftentimes. So most companies, they're going to fail at some point. They are not going to get to that level or that scale. There's other companies that do remarkably well, and they just decide we're not going public. They never go public. They stay private. There are disclosures that those public companies, they have to offer for their investors. There's all kinds of different hoops that they've got to jump through that private companies don't have to. Now, of course, private companies, they have to jump through a lot of hoops and they've got to pay taxes and do all kinds of different things. So that's not to say that they get away from all that the public companies have to do, but there's a whole nother level of disclosure, of transparency that needs to be present for public companies, because if it's not, then you have people who are kind of in the dark of the management philosophy, and they're more at risk because they have capacity to buy those on that market. Whereas private companies, you can't just walk in to a Chick-fil-A and say, well, instead of buying that milkshake, I'd like to buy 10 shares of Chick-fil-A. Right. Not going to happen. It's a privately held company. So that would be one of the chief, those would be the chief differences.
Right. And as we think about being an owner, if I am an owner of a company, when they make a profit, if they decide to pay a dividend or there is gain in the value of the company, my gain or that portion of the company's profit that is pushed back to me, I participate with that company. So you want to talk us through a little bit more about those dynamics of how, as an owner, I'm participating with the company.
Well, we would say that really that level of ownership places even more responsibility for that decision on the individual who is an owner rather than just the person that walks into the store and makes a purchase. Yeah. So this is where we have some clients that say, well, I don't really want to own Amazon because of ABC, but they might still purchase some things from Amazon, which we understand on some level. But if you really don't like Amazon, you probably shouldn't be purchasing, things from Amazon to the extent that you can avoid them, because again, they're going to profit off those purchases. So if you have a real problem with Amazon and its operations, it's the way that they run their business, then exiting both would be helpful. But if you've already exited from buying from that company because you have problems, the next step would certainly be don't own the company. If you're going to avoid it, wholesale because you have problems with it, owning it just means that you're taking it up another notch, there entirely as you would participate with the gain there.
Right, absolutely. Well, and I think Eventide does a pretty good idea here of thinking about those enterprises. Are they value creating enterprises or value extracting enterprises? And so just thinking about these, if we think about value creating, those that solve real problems, serve people, generate wealth through service, they're looking and seeing there are needs in the world. How can I solve those needs in a way that actually honors image bearers of God? Similarly, value extracting enterprises are those that primarily profit by addiction, exploitation, predation, or degradation. We're thinking about things that may reduce the honor bestowed upon humanity, or the honor bestowed on creation as God calls creation good. Are those enterprises seeking to exploit, or are they seeking to create value? And I think just as we look at the landscape of being a public equity owner, I think this is where we can't just put our little plug in our nose and be like, well, the S&P 500, it's got some stinky companies, but I'm just going to plug my nose, pop the pill, and I'm going to swallow it down. And I think we really have to wrestle with what are the value creating enterprises? What are the value extracting enterprises? Do I really want to profit alongside all of them?
Right. And there's some companies that we've talked about this, but they're right in that gray area. So, I think about companies that manufacture soda and snacks. Just like, are these the greatest, value to humanity? No. I mean, at the same time, are they the worst thing in the world? No. I mean, if you have soda from time to time, is it the worst thing? No. Right. But is it something that, as an idea in and of itself, it's really enhancing humanity's experience? Is it pushing us towards knowing God more deeply, or preserving life? No, not anything in there. So there's plenty of gray areas in here that we have to just recognize that it's not easy to say, okay, yeah, I'm really drawn to that company. I'd love to invest in that company. Nor am I just repulsed by that company.
Right, absolutely. Okay, so we've got this idea of what does it mean to be an owner. Let's talk about what does it mean to be a lender. Talk us through what is a bond, because I think there can be some complexity and differences about lending. So talk us through, what does it mean when we buy a bond?
On the equity side, again, we're owners. We make an investment. We participate in gain. One of the things that we didn't talk about is we have the capacity to vote on proposals, shareholder proposals. So the board may come and say, well, we need to replace this board member. Here's our 3 candidates. Here's our preferred person, but you get to vote, on that. There may be another shareholder proposal that says, we think that this company should not buy anything from, Chinese companies because there's too much of a risk that there might be slave labor from, Uyghur work camps or something like that. So the management team might have their feet held to the fire by this proposal because it gets aired, and it might not even be voted on, but it might be discussed, among people. Well, if you believe that the company in their supply chain is working with companies that are that have slaves, you might really raise your voice there and get behind, those that are bringing that shareholder proposal. So at any rate, the equity side of things, you have voice there. You can vote on those proposals. On the debt side of things, this is a loan. Essentially, it could be a loan to a government. Like when we purchase U.S. Treasury bonds, we are in essence loaning money to the U.S. government. So this is a loan, and there are all kinds of different loans. Could be governmental loans, could be loans to municipalities. So this could be a state or a city, or it could be a loan to a particular project. So if they're constructing a highway from one city to another to make it easier to go on that, the loan might be, the municipal bond might be to construct the highway, and then you get paid off based on the revenues of that highway. So all kinds of different ways that you can invest in government bonds or make a loan to different governments. You also can invest in corporate bonds. So you are lending capital to corporations. So you might have Apple that says, okay, we're going to have a bond issuance that's $100 billion. And the purpose for this is that we need to expand our operations and move them, from mainly manufacturing in Taiwan, and also set up now a plant in Mexico and set up a plant in Arkansas, wherever. So that might be to finance those plants. Now you might say, well, why wouldn't you just use all of the cash that you have on hand, Apple, because you've got $200 billion or some crazy number, there. But they might say, well, we need that as a margin of safety should we see, the global economy have a big downturn or something like that. So they might say, yeah, we know we're going to be paying you 5% in that corporate bond, but we're fine with that because we want to have enough cash over here on this side to be able to do some other things, or to have a measure of safety if certain things should happen. So you're lending the company, you're lending them money, and there's a term to this usually. It might be 5 years or 10 years or 30 years, whatever the term is for either the governmental or the corporate bond. You're going to have a term. It's typically going to be for a fixed period of time. You're going to have a fixed interest rate in most environments there. And then at the end of that term, you're going to get the initial capital back, in that bond. So you're going to be paid some amount. Let's just say you put in, $50,000 into an Apple corporate bond. They might be paying you 5% per year. So you get $2,500 on an annual basis for that $50,000 you invested. And then at the end of the term, you get that $50,000 back.
Right. So then, Spencer, from just a general perspective, what are some of the other key differences that we didn't talk about with stocks and bonds?
Well, on the bond side of things, again, you don't get to vote on shareholder proposals typically, but you are first in line. If something goes wrong, you're first in line to receive payouts there. So if Apple goes under, the stockholders theoretically would have their value erased. It would be the bondholders that Apple would be paying off by selling their operations, their plant, their corporate headquarters, whatever assets they might have there. So if they go under, typically it's the bondholders that get paid off some fraction of their initial investment. So if it's $50,000, and let's just say, the company goes under, stockholders get zero. The bondholders, they might get paid off 60 cents on the dollar or 30 cents on the dollar or whatever it might be. So you are first in line there. You have, again, less capacity to advocate in terms of how it's governed, but you do have more capacity sometimes in saying, well, you cannot issue any more bonds unless you pay me off. So there are certain things actually written into corporate bonds that would allow you to tell the company you can't go in a certain strategy. You can't add more debt sometimes, or maybe you're still first in line or whatever the case might be. But sometimes with bondholders, you can hold a company's feet to the fire so that they can't do certain things within their capital structure overall.
All right. So now, Spencer, we've talked about the public bonds, public stocks. What about just holding money at my local bank? How do we think about that?
Yeah, and that's a good one because, some folks would say, well, I don't want to invest in corporate bonds or treasury bonds. I don't want to invest in stocks. So I'm just going to keep these resources here in a CD with my local bank, or I might just want to keep it in a money market account with the local bank. just be careful, if you go that path, because your local bank, they're going to use those funds that you have for something else. It's going to be in their capital structure. So, if it's an institution that has core Christian values, and they say, well, we're not going to engage in certain enterprises, which would be very uncommon, very unusual, but there are credit unions that go that path, then you have a difference there in terms of how that's being managed. But it's interesting. Sometimes we'll have conversations with clients that they say, well, I don't want to invest in this particular arena. I'm just going to keep my resources over here in the bank. But then we see the bank is lending to all of those types of institutions that they wanted to avoid. So in essence, they're keeping the money with the bank, and then the bank is lending to everything they're trying to avoid. So we want to be real careful as we look at this and say, well, make sure you understand where your funds are. Not to say that you should change any one bank or another, but just parking resources with the bank, you're clothing the bank with capital still there. It's still the same investment and same criteria that we would want to look at in terms of not profiting from ill-gotten gain.
Yeah. Well, as I think as we close this out, it's what am I pursuing? What am I enabling with those resources that God has placed in my hands? Because at the end of the day, we are stewards of the resources that God places in our hands. We get the opportunity to deploy this capital, and we want to be proactive in how we think about deploying it. And I think oftentimes when we think about the capital markets, public stocks, public bonds, there's so much information out there. You turn on CNBC, Yahoo Finance, any of these places where you can get information, and it's just a deluge of information over and over and over, and it can be completely overwhelming. And so the path of least resistance is, let me just avoid as broadly as I can, maximize risk-adjusted returns. But I think as we come back to what does it mean to be a steward, it's really asking that question, how am I clothing companies in capital? What am I embracing? What are those enterprises? Are they creating value? Are they extracting value? And I think as an investor, we start to ask the question to begin with, and then we start building strategies around, okay, how do I be faithful to the Lord? How do I be faithful to the Lord in my public stock purchases? How do I be faithful to the Lord in my public bond purchases? We would say there's a wide array of opportunities out there. As this space gets more and more and more mature, there are more public ETFs and mutual funds that say, here is a way that you can avoid ill-gotten gain. Here is a way that you can avoid human flourishing. But I think as image bearers, we need to actually start in that conversation. We need to start saying, okay, what are the public companies that I'm investing in? What are the bonds in those companies that I am lending money to? Am I parking way too much money at the bank so that I can avoid that uncertainty, fear that I have? But let's really actually pursue into what does it mean to pursue human flourishing?
Well, and I think you highlighted something that is really important when we think about publicly traded stocks or publicly traded bonds. There's a liquidity value there. You can sell those on a day-to-day basis. So the alternative would be the private side of things, which is much more difficult to sell. So, as we think about investing, we are clothing companies with capital. We have this high and holy calling as stewards of God's resources, but we also have to know that there's times that we need to tap into those resources, and we don't know necessarily when we're going to need to do that. So with some of our investments, it does make sense that we keep them in a publicly traded environment because we can much more easily tap into them there than keeping everything private. Now, if you say, okay, I'm a physician, I'm going to work until I pass away. I'm going, we have friends that they're in their 80s and 90s, that they're still working, still have a job that they can do. Fantastic. But for most folks, they're going to retire at some point. They're going to need to pull resources out. And to do that efficiently in the short term, it's got to be publicly traded. Right. So there is a real value there that we don't want to discount. And really the way that our culture has set things up is to say, well, we're going to hold the managers to a standard of having as much return with as little risk as possible in as short a time as possible. So there is a level of wisdom to this. There is a logic to this publicly traded component that allows liquidity, but some of the undergirding foundations are antithetical to the Christian narrative, and we just have to recognize that.
Absolutely. Well, to close out today, we want to come back to Hebrews 13:5. And the writer says, keep your life free from the love of money and be content with what you have. For he has said, I will never leave you nor forsake you. And I think if we take that to heart, we can be content with what the Lord has provided for us. We put our trust in him first and foremost. Then our risk, returns, and time horizon are unbound by earthly things because our contentment and our trust is in the Lord. We don't want to get out over our skis if we need the resources to live, but also we look and we say, money is not my provider. God is my provider. So clients, if you would like to have the conversation with us about where you are invested on a public equity side of things, on a public debt side of things, even on a private side of things, we would love to have that conversation with you. And until next time, take care. If you found this episode valuable, share it with a friend and subscribe on your favorite podcast platform so that you don't miss the next episode.
This content was provided by Second Half Stewardship. We are in Knoxville, Tennessee, and you can visit our website at www.secondhalfstewardship.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult your professional advisor before taking any action based on its contents.